Welcome back. In the last lecture, we reviewed a number of anomalies that seem to go against efficient markets. For individual investors like you and me, however, the question really is, can skilled investors, like market professionals, make consistent abnormal returns, right? Can they generate performance superior to, for example, a passive index fund that just buys and holds the market, right? Ultimately, that is the true test of market efficiency for individual investors. So in this lecture, we're going to look at two types of market professionals, namely the stock analysts who issue recommendations and mutual fund managers who actually manage portfolios. Well, let's start with analysts. Analysts make recommendations on whether securities, right, a given security, is a good investment or not. Right? Their recommendations can range from strong buy, right, with a 1, to all the way to strong sell. Now, remember what we discussed about semi-strong market efficiency. If markets are semi-strong efficient, it should be impossible for analysts to add any value because prices should already reflect all the public information, right? On the other hand, analyst recommendations may contain additional information, right? Perhaps private information. Or it may they may contain and reflect information that the analysts can extract from public information because they are better at processing the information itself, right? So let's look at what happens when they release their recommendations. Well, the evidence shows that the recommendations indeed do contain some information, right? The market seems to respond appropriately to this information. So on the left-hand side, you see that the price jumps in response to a positive recommendation. And on the right-hand side in the graph, you see that the price drops immediately in response to a negative recommendation. Right? So on the surface, right, there seems to be some evidence that the stock analysts, in this case, add value if we believe that these reactions reflect the market's recognition of the analyst's superior information and that, therefore, these recommendations contain new information. Now, of course, the question remains as to whether these patterns are indeed new information or simply the result of, for example, buying or selling pressure following the recommendation, right? Or even whether these patterns are exploitable by investors after incurring the trading costs. Or in other words, are these big enough, right, to make profit? All right, so now let's look at mutual fund managers. What about mutual fund managers? Do they earn abnormal returns? Well, here we have to be a little careful and a bit more specific. Okay? So first, remember that the efficient market hypothesis does not mean, right, fund managers or funds never earn large abnormal profits, right? But that such performance could only be due to sheer luck, right? So we need to assess whether the superior performance of a fund manager is indeed due to skill or maybe he just got lucky, right? Second, high-risk investments should earn higher returns. So funds could earn higher returns if they are pursuing riskier strategies. But that, of course, that would not be abnormal performance. That would simply be appropriate compensation for the amount of risk. So what we need to do is we need to look at risk-adjusted performance. Okay, so what's the evidence? Well, there's a huge number of studies looking at mutual fund performance. And the basic summary of this enormous literature is that mutual fund managers slightly beat the market or equal the market before costs, before fees, but on net, they underperform. The average alpha, in other words, the that is the abnormal return after adjusting for risk, whether you use the CAPM or the Fama-French three-factor model, is negative, right? Now, this does not mean that there are no fund managers out there that add value. But finding these managers is hard because there is little persistence. Okay? So why do we care about persistence? Well, persistence is important because it would suggest that performance is not just luck, right? The performance is, in fact, due to actual skill and not just sheer luck. So, for example, we should expect to see a skilled fund manager to do consistently well, all right? So that investing in funds with past good performance should consistently generate higher risk-adjusted returns. Again, the evidence is not very supportive of persistence. Suppose today you sort all funds into 10 groups, right? Put the very best funds in the top decile in group 1, in decile 1, to all the way down to the worst funds in decile 10, right? Group 10. And suppose you looked at their performance over the next 5 years. Well, think about it. If there is persistence, right, you should see the top performing funds to be doing consistently better, right? So in this graph, you see the results of exactly that experiment, right? The subsequent 5-year performance of top performing funds versus the subsequent 5-year performance of the worst performing funds, right? So the x-axis is the time, and the y-axis is the average monthly excess return after adjusting for risk. Okay? So what do you see? Well, you see that there is very little in performance after 5 years, right, between the top performing funds and the worst performing funds. And more importantly, the very best funds, in fact, are now underperforming. What if you sorted the funds based on their returns last year and looked at the alphas this year, right? So if they did well last year, do they do well this year as well, right, if there was persistence, right? So in this graph, you see exactly that, right? So the blue bars show you the CAPM alpha, right, the abnormal return after adjusting for market risk. And the red bars show you the 4-factor alpha, right, the abnormal return after adjusting for market risk, size effect, value effect, and momentum. Well, what do you see? Well, the funds that have done really bad last year do the worst this year. Well, I guess that's persistence, right? But it's the wrong kind of persistence because it says that if you're a really bad fund, you're going to be a bad fund next year as well. More importantly, across all the 10 groups, they all have negative alphas, right? Adjusting for risk, the abnormal return is negative for all these funds. Well, you might say, well, what about these superstars that we know about? Do they not exist? The Peter Lynch's, the Warren Buffett's? Yes, they do exist. But the overall evidence on professional money managers at best mixed, at worst not great. Consistent with the idea that markets are pretty much efficient, right? It's not easy to consistently outperform the market. So it's not so surprising that in recent years, the passive funds have grown tremendously, right? Eating away the share of active funds, which are still very actually staggering, the amount of the size of the active funds. All right, so are markets efficient then, you might ask? Well, in this lecture, we looked at the performance of market professionals. It appears that markets are generally efficient enough, right? Here's the takeaway. Any supposedly superior investment strategy should be taken with a grain of salt, right? The market is competitive enough that it appears only differentially superior information or insight will earn you the extra money.